So the first question, after having gone through the foundation of knowing who you are, putting a strategy in place to say, right, this is what we do. The next question is, how much will that strategy cost? Do you have a clear idea? Okay, and the question that we've asked, starting point for that, is really the work plans. So you're going to take your strategy and boil it down to exactly what it is that you're going to do, because you can't cost something when you have no clear idea of what it is that you're actually costing, what it is that you're going to do. You can have some broad strokes, either the staff that we have and so forth, but really it does boil down to the plans for that particular year. So that's your key starting point. And then also to consider what your cost drivers are. So as the word says, these are the things that drive your costs. They influence your costs. They affect how much things are going to cost. And in some cases, we look at the key elements within an activity. So let's say it's a workshop. The core costs are going to be your venue, your catering, things like that. And you can say, well, this is how much we're planning on it costing for the year. But really the next step up is to say, well, how many workshops we're planning for the year is going to affect our cost. How many children we have on our program is going to affect our costs. How many geographic locations we work in is going to affect our cost. Those are the things that drive the cost. The quantity, by increasing or decreasing those elements, your costs will change. And so identifying those cost drivers is really key in understanding how your figures work and how much your plan strategy is going to cost you. And then always to have a look at what your operational commitments are that need to be included as a bare minimum. So staffing is a big one. You have a commitment for staff. Some organizations have fixed term contracts, so their staffing commitment may change and you'd need to be aware of what you're committed to for those staff. You might also have things like rental agreements. The worst one is telecom things. You can't get out of that for 2 years. So, even if your circumstances change, there is that commitment that you've made, signed the contract, and that cannot change. So those things need to be factored in. And then beyond that, you're needing to have a look and see, okay, well, what are the long-term initiatives that we want to be funded? What is the nice to haves, the big picture? Maybe it's not even nice to haves. Maybe it's more, what are the absolute essentials you need as an organization to be strategically minded and planning for the future and putting those things in place? Maybe it is a learning event. Maybe it is organizational development. Maybe it is staff capacity identification and working out where who's best at doing what, looking at sort of strengths of the staff and the complement there and where your gaps are. There are many initiatives that you can engage with to make your organization more sustainable and more effective. And so those things also need to be costed into your plan and to get a complete picture of what things really cost. Okay, so that's the first thing. Then the next one is asking the question of how much will the budget change during the year? And this is something that people really struggle with, and this was before even things like COVID, which totally threw the budget out of the window entirely, where people say, well, I don't know yet how much money I'm going to get in for next year. We're in November next week and I don't have all the funding committed. What do I do? What do I present to my board? What happens when contracts come in during the course of the year? What happens when COVID hits or some other unusual event happens and limits what we are able to do or what we want to do? How do I balance that between the various budgets? So my answer to that question is really that there are essentially three documents that you would typically have within an organization. The one is a fundraising budget. And somebody said to me the other day, there is this expectation of boards that the budget must be balanced. You must have income matching expenditure. But then when you submit that to donors, donors go, well, what do you need me for? There's no gap. There's no objective for them to contribute. So a fundraising budget typically will be, if we got in all the money that we wanted, this is what we would do. This is the real ideal, and there would be a gap within that. And how you present that to the donor would depend on the donor. And so you're wanting to have that as a fundraising target. It's your sort of aspirational budget. Then there's the one that actually gets approved by the board. It's your firm document that you work towards, you report on, you internalize. That is typically developed before the beginning of the new financial year. And there may be a gap there that you say, this is the amount we are still needing to raise. This is where we expect to get it from, because I would expect your board not to sign off on a budget where you have no idea where you're planning on getting some of the money. And so that's pared down. It's more realistic. Based on what we know at this point, this is our most circumspect picture for the financial year. And then the next one is your working budget. So you're 6 months into the year. You can no longer really track based on the approved budget because so much has changed. And so you're then saying, well, this budget, the working budget, should really match your income to your expenditure. If we don't get the money in, what are we going to do? What are we not going to do? Where are we going to be if this is the picture that we're in partway through the year? And often what you find is that in a board meeting during the course of the year, that working budget then becomes the budget presented to board to be approved as a revised budget. And so then you have a new approved budget that's more closely aligned to the financial picture you have at that point in the middle of the year. But you may find as management that you need to have something a bit more concrete during the course of the year that ties in with what you actually have committed. So the budget to me is never one document and it's never set in stone. The approval of the board is a very nice stake in the ground. It gives you something to measure against, but there is always opportunity for change because that's life. The only thing that is certain is change. So one thing to also consider is the COVID implications. You know, how much has that impacted the way you spend, what you do, how you do the work? There are factors involved there, and your budget may need to change. And I think building in those processes for review and revision will mean that any kind of unexpected change can be accounted for and adapted to. One of the things that was asked of us last month was to talk about remote working, and it has impacted financially for some organizations. There is obviously a team building, mental health element to working from the office or working from home, and that cannot be underestimated. But there's also a financial consideration in terms of productivity. Some it is better from home, some of it is not. And then also the considerations of data costs and access to reliable internet, electricity, even things like a setup of a desk. One of our clients the staff member was very pleased to go back to the office because she would literally for a year been sitting on her couch working off her lap because she didn't have the structure set up in place. And so that is something that you need to consider as an organization. What are your requirements for staff? is it to come back to the office full-time where available, when lockdown allows, and then if not, if working from home is an option, what are the cost implications for you to ensure that your employees are able to actually do the work from home? Because there may be cost implications for you to consider as well. And policy ones. One of our clients has now written a policy in about internet reimbursement, because that's something that they recognize is now not just a short-term issue, but is now the way that they work. Right. So the next question I have for you is... Can I
interrupt you there, Michelle?
Yes,
you go back to that slide, because there's a few things here that Fiona's brought up.
Right.
And
I can't keep track of the chat while we're talking.
Fine. So she's saying that that's exactly what happened to us. And when you were talking about change in budgets and things like that, they said they got new board members, a new chair, didn't want to approve the budget with any deficits. So we curtailed all expenses, even took off salary increments to accommodate this. Then our budget is actually skewed and no longer real. I'm sorry, Fiona, I feel for you. But my whole thing in there is that if the board and the management, is there a best practice on how often you could revise a budget, or is it just where needed? Is there any legal sort of stuff of having an approved budget and actually, applying with that, or can it be changed under circumstances as often as required?
That's a question directed to me.
Yeah.
So there is, it's not so much a legal requirement to have an approved budget. I've worked with organizations where they've kind of worked a budget out and shown it to the board, but no official approval process, but it is good financial management practice to have the board must see the budget and the board must approve the budget, because from a governance point of view, the board has delegated authority to management to run the organization, and the board is responsible for managing risk, and that includes the financial risks. So that's also where this idea of the budget being balanced stems from, is because if you're showing a deficit in your budget, it is a financial risk. And so obviously certain boards are very averse to risk and very cautious when it comes to risk. So they're required to manage risk. And by seeing and approving and officially adopting the budget, they are both executing their mandate to engage with risk, but then also giving the board a delegated framework within which that they can financially manage the organization. I've reviewed a finance policy manual recently that was saying any expenditure over a certain amount or any unexpected expenditure needed to be approved by board members. And we went back and said, well, actually, if the board approves the budget, what fits within the budget is then within management's control. Anything that exceeds or deviates from the budget then goes to board. So the budget really is a mechanism of delegation. Okay. In terms of changing, there is no requirement of it has to be revised or it doesn't have to be revised. It's just about finding a good balance, because probably the day after the board approves the budget, something will change and management will go, oh, we heard back from that donor and this money has been approved. Now, if you every week go back to the board with a new budget, nobody knows what you're tracking against. There's no clear delegation. There's no structure there. So you don't want to change your budget too often. But it is also unreasonable to manage an organization with a budget that is so defined so far in advance. You're looking at 12, 14 months from the end of the financial year you're in, and then having to account for any variances against that budget when the whole situation has changed, particularly when you have something like lockdowns and COVID and all that kind of thing. So it's ideal that the budget is revised at least once within a 12-month period after it's been approved. But if situation changes, more often is also possibly the reality. So.
Okay. And you mentioned something interesting there. You said that the board is required to. That's a legal requirement, isn't it? Because they're members of the board.
Yes. So it's a little bit unspecified. So depends on how you're constituted. Now we're getting into a little bit of detail here. If you're a non-profit company, you have to comply with the Companies Act. And there are very explicit requirements in terms of directors for the Companies Act. When you're incorporated as a voluntary association or a trust, it's less explicit. So then you're looking at the Non-Profit Act, which has some criteria, but it's not very comprehensive. So what often organizations will do is they will abide by a corporate governance code. So we can get into this at another time. There's one called the King Code, and then Inyatello have actually developed one specifically for non-profit organizations. So the board then agree with, sign off that they will adhere to that code, and those kind of things are included in that corporate governance code.
Okay, thank you.
Okay. Right, and we've got this. Mark is saying a basic delegation of authority and authority levels can be set as a guide to management and the board. Absolutely. The founding document covers certain roles of who's responsible for what and what can be delegated, but it is very important to work on a terms of reference for the board that clearly states how the board acts, what they do, what they don't do, and so forth, and outlines it quite explicitly. Often these things are assumed and people have this understanding without actually having it explicitly agreed. So that's a topic for next year. Mark wants to talk. Well, welcome to go ahead. Just unmute yourself.
Thank you. Sorry, I thought I'd just say this better than I would type it. Forgive me, I'm not sure who's in the room and what context they have in relation to this, but my experience has been that often, there is boards are very much, they have a fiduciary duty, which is, it's always not an issue until it becomes an issue. And so boards by nature tend to be a bit conservative and careful. They have to be. That is their responsibility. They're not there to sort of rah-rah management. Unfortunately, that can seem rather cold at times. And some of the documents, like a simple board charter, a board calendar, a budget, these are actually the tools that a board can use to ensure that there is good governance in an organization. So management ultimately can thrive. But what does tend to happen, especially on the management side, is these things are seen as like a hindrance or like no, it's too much, just overdoing it and thinking, well, this is not a big board. You often hear this statement, it says it's not a big board, but the principles still apply. And so if management works with your board on getting these things done, and once you put them in place, they're quite easy to update yearly. They really do in the long term make a big difference to the organization, because the organization can't really scale and grow if good governance is not there. Eventually funders will look at your governance. Do you have a board charter? Do you have delegation authority? Do you have an approved budget? If you don't have these things, larger funders get hesitant, as rightly they would. And if they don't, then, well, yeah, it's amazing. But I thought that's just worth saying, is that if there are, for example, people here on the management side, and you find these things a bit of a pain, or you think, why does the board have to be so difficult? It's actually because those are the tools that actually do, in the long run, have a purpose, and they do work. Thanks.
Thanks, Mark. You're absolutely right there. We actually had considered next year's webinar series looking at some guest speakers. And one of our contacts or associates, well, I don't know, partners, focuses on governance. And I think it might be worthwhile actually having a webinar on governance for organizations. So that's definitely something we can look at doing, and having a guest speaker on that, because it doesn't matter how big your board is or how big your organization is. These are sort of that foundational level of compliance. Absolutely. Right. So then we're getting into a little bit more of the specific. Oh, we've got a Fiona, you've got a hand. Sure. You want to speak up?
Yes, I just wanted to add, in this week we were on a session with National DST because they are currently going through an amendment of the NPO Act, which has never happened since 1997. So in this process of suddenly now, before election, I would assume, trying to work on Amendment Bill and get it pushed very quickly, one of the things that really concerned us, and there was over 200 NPOs on that session, was one of the reasons we kept going back and saying is one of the things they really want to get right with the NPO Amendment Bill is the fact that a majority of the NPOs have issues with theft and money laundering within them, and I mean, obviously sweeping the broom across everybody, and it could be limited to a few. So we were quite concerned because often that's what happens. You'll get the odd ones who obviously the boards are having more control operationally and managing that NGO. And sometimes, yes, of course, they're not managing their funds appropriately or following proper financial controls or measures in terms of the protocols they're following. And then that leads to a negative perspective of all NPOs. We all get painted in that same brush when they point fingers and say nationally, we don't know how to use the funds we have. So that is a huge concern, and I think it's something that's going to be debated on with this current amendments that is happening right now, because they were openly throwing those terms out to us.
It's very disappointing because, as you say, it's the one bad egg that then colors everybody's perspective. That also people in just general public, you talk about nonprofits and they have this somewhat negative view sometimes because they've heard of somebody who's run off with all the money or things like that, and it's really disheartening because that is not the situation and that is not the case. Yeah, it's very interesting to hear that you're involved in that process, and I'm pleased that there's some voices of reason in that process, so that's good. Great. So we're going to get into a little bit of the sort of specifics and details of actually drawing up a budget. And when we ask the question, have you accounted for all types of costs? And this is one of the things that I found typically finance people or management who putting together a budget haven't really sat back and looked to see, have we actually accounted for everything? And so there's sort of three categories of costs in my head. And the first one looking at fixed and variable. And so some costs might fit into all three categories. Okay, so these are not sort of groupings within your budget. These are types of ways of looking at costs. And the first one is fixed and variable, where you're saying, is this something that we pay every month regardless? That's, it's a fixed cost. So those are quite easy to pick up. They typically are things that you're committed to. So, your rental of your telephone, your rent, your staff costs, etc., etc. So those you can plot in quite easily. And I say the rental of your telephone because the actual telephone calls often are a variable cost, and because they change unless, but we don't have a phone anymore. We only use our cell phones and we're on fixed contracts. And so that then becomes a fixed cost. Stationery, all of those sort of things are going to be variable because you're predicting an average, you're estimating an amount, you don't have the specifics. And so they're less accurate when it comes to your budgeting. The second one that I think is the most helpful sort of way of starting the budget, and when you're looking at things, is plotting your monthly costs. That's easy enough. Most people do that. They'll take a column for each month and they'll plot, there's our salaries. If you're lucky enough for bonuses in December, then December is double. There's the rent, there's the, those core things that are a monthly cost. But then we often forget to include the annual and the ad hoc. And sometimes the ad hoc, if you're doing monthly columns, you have to guess. But you have your annual subscriptions to software. You have your annual compliance requirements. You've got to pay your accountant for your tax return once a year. Those sort of annual things that we completely forget about when we're focused in on a month-by-month way of operating. And then there are also the ad hoc ones that you don't necessarily recur every year, but are something that you are wanting to engage with. So the nice, easy ones for an example is a vehicle. So your fixed cost is your insurance. Every single month you're paying your insurance. It's a monthly fixed cost. Your fuel is a monthly variable cost. You're paying that. Then annually you have your service, which is an annual variable cost, and your license, which is an annual fixed cost. But then you decide you need to regas your air conditioner or change your tires. These are then the ad hoc costs that you're not necessarily going to do every single year, but do need to be factored into your budget. So this is really where it comes to your work plans. What is it that you're wanting to do in the year? Because these are the ad hoc things that maybe you didn't do last year. Often we will take a last year picture, add a percentage for inflation and go, right, there's the budget for the next year. And that's not reasonable if your plans are changing and you need to adjust your ad hoc expenditure. And then the last category of costs are your direct and indirect. And this is typically in relation to the objective that you are working out. So your programs, the things that you do to achieve your mission, those are often considered to be your direct costs. And so it's a question for you, because it may not always be so obvious what is direct and what is indirect. Obviously, the flights and the workshop costs and the food and the, those are easy to identify as direct program costs that are required for the outworking of your activities. And those will be often variable depending on the work plans for the year and your scale for the year. And then people go, well, salaries are indirect costs. You can't attribute it to a particular project, to a particular piece of work, anything like that, office costs, so forth. But that's where the challenge is, to think outside of the box. How do you justify typically indirect costs as direct? We talked about funding and in the challenges conversation, and we'll talk about it a little later, and saying, well, if donors like to fund direct costs, how do we make the indirect costs direct? And so it's easy enough when your program staff can be specifically assigned to a particular program. If you have a person, a project manager for that project, that's easy. Then their so-called indirect cost becomes a direct cost to that program. And you're then left with a much smaller pool of overarching management and admin support and bookkeeping and things like that that are working on a multitude of programs, and it's difficult to identify how that is split. Same with the operating costs. Bank charges, for example, might be across the organization, but you may have a system where you're able to split the photocopying or the printing or the vehicle usage based on things like logbooks and tracking mechanisms to be able to say, well, these costs are really direct to a specific project or programs. So that also depends on how detailed you want to get. So what I've often seen is that there's an aspect that is directly allocated to the specific project, and then you might find that there's like program management that is an overarching project cost and considered to be direct to the project, but not to a specific one. And so that becomes sort of an umbrella, and then the management, senior management, becomes indirect costs as an even higher umbrella. So it is interesting to challenge your assumptions of what you consider to be direct and indirect, and how to think outside of the box in redefining those categories and what you put into what box, and how you present that in your financial, into your budget and your financial reporting. Okay. Moving on to the last slide. I think this is in our, the sort of detailed explanations, which is how do you cover core personnel and operating costs? And these are some suggestions. There's no right answer, there's no wrong answer, and not all of them are easy. And not all of them work all of the time. It very much depends on donors. And so the first thing is, how do you present it to the donor? There are two broad categories of presentation of financial information. The one is by what we call in accounting terms by nature. So you're grouping things by things of like nature. So when you present something by nature, you will typically have salaries together. Maybe you'll have a personnel costs as a heading, and you'll have things like staff development, staff welfare, and salaries all together under a personnel heading. Then you'll have things like office costs, and you'll have communications, and you'll have workshops, and you'll have categories of activities that might be grouped into projects, but it is by the type of expense it is, right? And that's incredibly helpful from a management point of view, because you need to know what your total salary bill is in order to make sure that you spend that and that you're tracking against that. You need to know what your total operating costs are. But when it comes to presenting to donors, another alternative, and I'm saying an alternative because some donors insist on the by nature, another alternative is to categorize things wholly by their purpose. And so for largely the purpose is around the programs or the projects. So then you're taking those costs and assigning them to a project. And the basis of assigning them will differ depending on each organization. Sometimes you'll say, well, of our staff complement of 10, 3 work on this project, 2 work on that project, and so we'll allocate 3 out of 10 of our costs to that project and 2 out of 10 of our costs to the other project. And you do it based on number of people, you do it based on the total expenditure, there's a range of options when it comes to how you choose to assign your costs, your indirect costs, to the projects. So when you're presenting to the donor, you're then saying the total cost for project A is 400,000. When the direct costs are 100,000, the direct staffing costs are another 100,000, and the operational costs are the balance. And so that's not easily visible to the donor because you're showing them, we need you to contribute 100,000 towards the 400,000 Rand cost for this project. And that includes all the costs. And so you're actually presenting it in a way that groups things together and invites them to contribute towards the project as a whole with the full cost of the project, not just the direct costs. And then I think, so that was, I've kind of answered, talked about point number 1 and number 2 in together, saying how are you presenting it to the donors matters, how you group things, what you classify things at, and the level of detail. So obviously depending on the donor, some require levels of detail, but I always suggest we start with the highest level of detail and then lowest level of detail, highest level, and then if the donor requires more, we go further and further into the detail there, because so often we give them a breakdown, such a tiny increments, so many activities, time, staff time, etc., that then there's no room to build in the overarching costs and the nice to haves and the bigger picture stuff. So always present a budget, if you have an option when it comes to templates and things like that, at the highest level, so that you're then able to show a broader picture and not be so tied to the specifics of of the detail. And then obviously the other alternative is to look for direct core funding. There are a couple of donors who do that, and there are also a couple of donors who have levels of engagement where they start off with project-specific funding, and if you prove yourself over time, you move to sort of strategic partnership level, where they actually fund you as an organization rather than funding a specific project. So my thinking again on the presentation to donors, wherever possible, present the whole organization to the donor, and then say, can you contribute whatever it is that they will contribute towards the organization as a whole? When you carve it up into projects and you carve it up into details, you then give them an opportunity to exclude things. And it is much better for you to offer the organization as a whole to the donor because you need a contribution to the pot, rather than offering a tiny little piece that then excludes. You've automatically excluded it for them, and that doesn't seem to be fair. So that's just a little thing. Then the very last one, which is not on there, is income generation. If you have a business arm, if you have a means of gathering unrestricted funding, then, or not unrestricted funding, unrestricted income from sales, then that definitely can go towards your operational costs without any justification or reason or having to explain yourself to anybody. So that is something else to consider when you're looking at those gaps.